So, how does someone switch from single family to multifamily? My guest today, Jonathan Barr, has flipped over 400 houses, has had a great deal of success in his business, and realized he was paying too much in taxes and it was too much work to actively flip another house, another house, another house. So, he has learned the art of syndicating large multifamily deals. He's with me here today. He's a good friend. Jonathan, welcome. How are you today?
I'm doing great. How are you?
Awesome, man. Well, I love your story. It's very inspirational about how, you were young, and I won't steal your thunder, but you basically got into that. Would you give people a little more of a background, kind of how you got into real estate and
Sure.
kind of what's led you to today and what you're doing now?
Yeah, so I grew up in a real estate family, as you know, and just always been around it since I was a kid, going to open houses with my mom. My daycare is basically my mom's office. After the last recession, joined the family business, which is a flip business, like you said, because I couldn't find a job during that time. So I joined the family business. Then we started going to foreclosure auctions. So at one point, we were buying 7, 8 homes a month at the foreclosure auctions in Los Angeles. And like you said, we did about 400 deals in a 10-year period. We also got into some ground up development in Los Angeles, so some townhouse style homes, smaller apartments. Also did some entitlements and sold properties to other builders. That was pretty profitable for us. And then also had a small portfolio of like 1 to 4 unit properties in LA that I lease and manage myself. So I've kind of been in the trenches as well. And during the holidays of 2017, I was in Kansas City and started kind of with my wife's family and started looking at properties there and talking to brokers and realized I could triple, quadruple my cash flow from duplexes that I had in LA. So I sold one of those duplexes and bought a 14 unit in Kansas City and quadrupled my cash flow and decided I need to do more of this. So my brother and I left. I bought that in November of 2019 and then started my own business with my brother to syndicate multifamily deals in February of 2020. The pandemic hit, which was a surprise, slowed us down a little bit, but then we ended up doing our first deal in September 2020, and that now we doubled the projections there. We've done another deal since that, another 69 unit deal, and then we just put another 118 unit deal under contract, and this is in Oklahoma City. And so we're just building that. A lot of the money's coming from stuff we've selling in LA, and we've begun to raise from other people as well.
Yeah, that's amazing. I mean, how you have changed. There's a couple things I want to touch base on
Sure.
because you are a single family, and primarily in the single family space. This is what I realized. I had a small portfolio of 4 or 5 houses, and I just realized, to scale, it just my return on invested equity, or my return on equity in the deals, was not returning as much. There's different things people do is they can pull money out and do more deals and things, but it's a very long, kind of slow process, especially if you're in a market such as Los Angeles, that's more of an appreciation market. And then, of course, if there's some sort of housing crash or something, you deal with that as well. But I've really, I feel like the saying "cash flow is king" really is true, right? Is that if you
Yep.
get cash flow, and you said I was able to 4x my cash flow just simply by selling these and rolling, and it's not uncommon, right? Somebody sells, you know a unit or a duplex in LA, and they can get, sometimes, 10, 15 units somewhere else. So it's funny how, in certain markets, it's
Yep.
just the returns are very different. Why do you think that? Why do you think some markets are, is it just people speculate and there's a lot of foreign money in LA, or what do you think kind of drives that causes just general returns to be lower for investment property in a place like Los Angeles?
Yeah, I think it's a lot of that. It's kind of a world class city. There's a lot of, people from the Middle East, from Asia, from all over the place investing there that push the prices. You also have a lot more regulation. So you have rent control. That also affects the market and affects a lot of times rents are pushed down because of that. So cash flow might not be that great, but the area around you where you own might be gentrifying and the general market be appreciating really well. And I'm not against it either. And it worked well for getting a start and buying something at a good time and it appreciating well and now having capital to invest into cash flowing markets. So it has its purpose, but it is tough in a long-term perspective to continue to do it in the LA market or
Yeah.
primary market like it.
Right. And so you were doing a lot of flips. You're obviously real estate family. Then you started to get a portfolio and have some investment property yourself. And then I know taxes were a part of the equation for you as well, right? As you realized, doing the flips and being more active and some of that, you found that multifamily gave you some advantages with taxes. Can you talk about maybe some people are not familiar with some of the advantages that you were able to get through doing multifamily?
Sure. So with flips, a lot of them are happening in less than a year. So you're basically paying taxes on ordinary income. I mean, we had different strategies to make that better, of course. But for example, the building that I bought in November 2019, I was able to do accelerated depreciation. And so essentially, you do a study to accelerate the depreciation. So probably about 20% of the building gets depreciated in the first year. So I bought this property for 1.6. I had about $250,000 in depreciation in that first year. And because I bought it at the end of 2019, I was actually able to get that bonus depreciation for 2019. And because I'm a real estate professional as well, I was able to offset all my salary and primary income in 2019 and basically pay zero taxes in 2019, even though I bought that property at the end. So it was like magic, actually.
Yeah. No, it really is. I think the real estate professional designation, if someone's not familiar, if you search just, the
Yep.
Google for real estate professional, it's amazing. I mean, the last couple of years I was doing my consulting job in the medical field, I was able to save 90K on taxes I would have paid. And it's amazing if you do more than, I mean, 51% of your hours and 750 hours a year, or your spouse does, then you're able to write off through a lot of these tax advantages. You get these big passive losses through multifamily deals, cost segregation. You can use that against ordinary income to defer or completely write off, which is absolutely amazing. So it almost feels like it's an unfair advantage, but that's why they write the tax code, right? Is that they want, the government wants to subsidize housing, and this is one incentive they give to do that. Um, can you talk a little bit about just that process? I mean, you really scaled very quickly, Jonathan. Obviously, you've had a ton of experience with flipping and renovations and single family and even owning those, and to go to a 14, and now you just mentioned like a 69 unit. Like, that's, someone could think that and just be like, oh my gosh, like how could you kind of scale that quickly, or how has that been from going from single family to straight, to a single or a duplex or smaller places to now 14 and then a 69?
But yeah, like you said, it was a process. I bought that first duplex in 2010. So it took me, 10 years to actually sell that and to get to appreciate to a certain point and also feel comfortable going out of LA, because I've only invested in LA, and it took me about 2 years to get comfortable with going out of LA. But yeah, even when we decided to go full force with multifamily, that still took a couple years. I did that first deal. About almost a year after that deal, did the next deal, and then about 6 months after that, did a deal after that. So about every 3 to 6 months, we've been doing a deal, and we've grown from like 0 units to over 150 now. We just put 118 units under contract, so that would put us at 270, and then we're looking at a couple more. So it all happened in process, and all happened with many conversations with investors over time, a lot of past colleagues, friends, everything, building a platform, building a brand, and building like who we are. It took over a year of putting out content and like talking to people and nurturing stuff, and broker relationships too, because that's another thing, is when you're new in a market, they don't take you very serious until you start buying a couple things,
Mm.
and having a broker give you a chance and get that first deal under your belt, then the second deal. And now that we are about to do our third deal, it's like brokers are like, oh, these guys mean
Mm.
business. They're actually buying stuff. They're actually performing, and they're looking to do more. I want to work with them.
Yeah, it really is amazing when, if you're not familiar with the multifamily space, it's just, single family, it's kind of like people are just looking for a buyer wherever they can find it. It's a bidding war. But with multifamily, particularly large multifamily, a broker may call one person or a couple people and say, hey, are
Yep.
you interested? And they'll typically, because they work on these deals, sometimes they take 2, 3, 4, 5 months to sell. They don't want to have somebody get in there and all of a sudden they can't close, or they're not going to work out. So they will take, even the sellers will take, substantially less money sometimes, to make sure a deal will close. And so that's why it really is an insider's game. And what you said is completely true. If you're buying in a particular area, as you are in Oklahoma City or whatever city it is, those brokers are going to get to know you and they're going to come looking for you. Versus when you're first starting out, for those that are starting out, it's hard to get a call back, right, from a broker because you're some out of town person if you're not buying in your
Yeah.
area. But once you're an insider, it's really opened things up. That's really neat. Now, so tell me a little bit about just the process of going to an out of area market versus you were doing all stuff locally. How has it been to build a team? And maybe what are some team members that you found really important and kind of as you've been scaling your business?
I think the number one person is the property manager. And that's what we focused on first when we were looking at the market. And the reason why we ended up in Oklahoma City was because Kansas City, just in that 50 plus unit mark, it just didn't make financial sense anymore because of the competition that had come there. A lot of like coastal money had gone there, and it just we need to get a certain return for it to be worth us going outside of LA. And if we don't hit that threshold, I'd rather just buy something in LA. And so Oklahoma City were able to do that. So we connected with our property manager there. That was actually we were their first property management client because they were owner operator. They had about 1,000 units in Oklahoma City that they own and manage themselves. Then decided to do third party management as well. But they also introduced us to our first deal. They knew the broker that had the deal, that brought us the deal, and that manager that didn't even really know us yet, but believed in our story and what we wanted to do, and kind of vouched for us. And we put that deal together. And they actually bought another property from that same seller, and it was kind of like a package deal, and they wouldn't sell unless they sold both of them. So that was number one, is getting a good manager that we felt confident that could do a good job, and they were performing really well. I mean, there's always things to learn and perfect as you go through the process, and they've been really malleable and willing to work with us on everything. So I think that's number one. And then after that, probably the vendors, like different contractors, electrician, plumbers, roofers, because once you get into some of these projects, you want to have someone you can rely on that can get the job done and get it done at affordable pricing as well. And then obviously, like we talked about, the brokers and making, like, we're huge about like calling them every 2 weeks or like emailing them, or every time we're out there, go to lunch with them and being constant communication, because they have 50 buyers contacting them on who knows, weekly basis or whatever it is, and they'll forget about you. And you got to be top of mind, and you got to like tell them about what you just bought, or keep them top of mind, keep you top of mind for them. So that's been huge.
There's that song that says, "Don't you forget about me," and it's like it
Yeah.
reminds me when you're working with brokers or whoever it is, just the importance of staying in front of people. And what you've been really good at, and you mentioned this earlier, the idea of really creating content as well as networking to help really connect with other investors or operators. Or I know you were at our meetup recently and got to
Yep.
share there in Pasadena. What are some things that you mentioned? Twitter. There's some things that you've been really good at. You focused in on certain platforms to really help to connect with people. And I think there's application of this, whether someone is an operator or if there's someone who is an investor looking to meet
Mhm.
sponsors. What are some tips that you have as far as just being able to network, especially for people that, maybe with COVID or just for whatever reason aren't able to travel as much, maybe through technology? What are some ways that you found helpful to network?
Yeah, so the place, like, I've been on active on Twitter. There's like a real estate space for Twitter. And basically there, on a daily basis, I post stuff that I'm learning as I go. For example, today I posted something because I have a CMBS loan with the yield maintenance on my Kansas City deal. And right now, it would make sense for me to refinance some cash out of there, but I can't because a $300,000 prepayment to be able to do that. So I'm kind of stuck there. And I learned my lesson there, and I posted about that, and I got a lot of hits and comments and all that kind of stuff. But I just whenever I'm posting something, I always think, is this a vanity thing? Am I trying to like stroke my ego, or am I actually trying to put something out there that's of value, that's going to help people, and that's going to the things that I've learned and the mistakes I've made can hopefully help a lot of people and the people that follow me. And it could be other operators, it could be passive people. Everyone could kind of learn. And then another part of it, if you are trying to raise money from people, it kind of gives you credibility and shows that you know what you're talking about and that you're thoughtful and that you're someone to be trusted as well.
It's really amazing for those, a lot of people that are interested in or are investors passively in deals would like to be doing deals themselves. And I think this whole idea of the thought leadership platform and where you're just creating new content, you're putting stuff out there. It's a lot of work. It's a ton of work. It's a lot to do. And you got, like you said, you think of it every day. We do it here
And
every
it
day. We're
doesn't
putting,
pay for it till later. It takes a
yeah.
while for it to get
Yeah,
dividends from it.
it's the long game, but the thing is, when
Yeah.
stuff's out there, Google finds it, YouTube, these different, or Twitter, the people start to find you, and then if you're adding something that is really valuable, people will truly say, "Hey, this is somebody who I trust." I remember there was a guy that when I first was getting into multifamily, I went up and I listened to hours and hours of his podcast, and I went up and was like, "Hey, how's it going, man? Whatever." And he'd never met me, but I just felt like I knew the guy, like he's my friend, right? So it's kind of funny how just by when people put information out there or they're continually, whether it's through videos or just even articles or things like that, when you bring value, you bring the value first, and then you make the connection, and you'll hopefully find a way that you find some sort of partnership later on. But it's interesting to it's great to see how you've done that. What are maybe some things that you found, or I guess I'll ask it this way, what are some tips that you would give to somebody who's a little newer, who is interested in multifamily and just really wants to learn more? What are some ways that people can educate themselves to become more knowledgeable about multifamily?
I mean, the obvious things is this podcast, so many number of podcasts, and there's so much content out there. You can go to my website. I try to put a lot of basics on there, like syndication 101 and all these things that for you and I might seem pretty simple and basic, but to other people it might be a revelation.
Mm,
Um, and then I think networking also with other people that are already doing it. Trying to get a mentor, I think, is important, either that you pay for or that you find someone that is willing to, spend some time with you, or maybe you help them for free to kind of learn things. And then I think a good way to get started is buying, like I did, a duplex that I lived in that I rented out a back unit, but I would probably have started a little bigger, maybe done a fourplex that I lived in one unit and rented out the other units, and kind of move from there, sell that to buy something bigger. And you kind of just like I did, I bought a duplex and a 14 unit, then went from 14 to 72. That's kind of a big jump,
that's a big jump. Yeah.
but it just, I felt ready at that time because of, the financial backing we had and the education I've got and the comfortableness of going outside of my market at that point.
Yeah, it's interesting. There's no real specific, here's how you do this, right? Like, just do this, do this, do this. It's
Yeah.
you got to look at your own situation. I mean, we had our small single family portfolio, and then my first multifamily deal was 225 units. You say, "Oh my gosh, Bronson, you must be amazing." And it's like, well, no, I had partners that were more experienced than me. I
Yeah.
was able to bring some, do some diligence, raise some money, do some different things, be a part of that deal. So it's amazing how with multifamily, it does become, a team sport. And like, you mentioned your team, and I have your brother involved, you got other team members that are there, which is really valuable. What do you see as right now happening? I know we've talked a little bit about this, Jonathan, but just the monetary stuff that's happening. We have 40% of all the currency that's been printed was the last 18 months, at least at the time of this show. How do you see kind of multifamily? How will that affect multifamily? And is it a good time? Do you think it will be a better time later? Do you think if interest rates rise, will that hurt multifamily? What are some of your opinions on what's next?
I mean, I think if interest rates rise, it'll definitely slow things down. I don't know if it'll come down, but that might make it stagnate a bit. But things in the last 12 to 18 months since kind of COVID and everything, values have gone up like 40% in some places, which is absolutely insane. Usually
Yeah.
values go up like 5 to 8% a year, if that. That's even a decent year. So
Yeah.
you've basically in a year you every quarter for the last like 18 months, we've had what happens in a year happen in a quarter.
Yeah.
So I don't think it's going to continue like that. I think we'll see what happens with rates, but I think things will, if rates stay relatively low, and rents continue to kind of come up and they continue to do so, I think we will see a steady increase. I don't have a crystal ball, but I also think a correction of some kind would be healthy. So we'll see.
Yeah, it's interesting. Yeah, no, that's great. There's inflationary and deflationary pressures, obviously with
A
the
lot of
money printing.
technology is deflationary.
Yeah, exactly.
So
And if interest rates rise, that would be a deflationary trend.
yeah,
Yeah, it would be interesting to see. One thing I think about sometimes is if interest rates rise gradually, it increases cost of ownership, which could also, even if cap rates, rise a bit, it still could kind of, income rents generally will go up with inflation over the long term. So it's interesting to see, but I don't know with all the money printing where a good place to put your money is besides commercial real estate where you get
yeah,
the debt
assets are going to
advantages and
inflate, obviously.
yeah, yeah, exactly. That's why we're in it, right? That's
Yeah.
why we're doing it.
Yeah.
So,
I mean, who would have known during COVID the government was going to print as much as they did? You
mhm.
know, I
Yeah,
think no one saw that coming. I mean, they knew that they had to do something, but to that extent was pretty extreme.
yeah, and it's amazing the charts. You see the charts that even the last, these the last 70 or 80 years, the dollar's lost 96 or 98% of its value. And if it's kind of hard to believe, but that's why people say, oh, a hamburger or a gallon of gas was only 5 cents, back in the 50s or whatever. It's not that the price has changed or the value's changed. It's just that we've printed so much more money. So we know in general that 5, 10, 20, 30 years from now, it's a continual trend. It's not going to change, right? And then the fact we can take debt out and go get these assets, it's almost like we're
I
actually
think it
shorting the
could
dollar.
change if the Fed stopped printing because of technology. We could actually have deflationary issues, but they're going to
Sure.
continue this trend. You know,
Right. Yeah. Yeah,
for
you're
the
right.
foreseeable future. I mean, I guess we'll see what happens.
Yeah, no, absolutely.
Yeah.
Um, so yeah, just I guess kind of going from that point,
I,
go ahead.
want to say
Yeah,
you guys. I think people should read this book. It's called The Price of Tomorrow. I don't know if you've read
oh,
it before.
I haven't. No.
It's really good. It's basically talking about how we would actually probably have deflation because of technology if the government let it happen, because and a lot of people might not have jobs, but things would become actually cheaper, that they could afford to pay for a lot more things that they're able to now, instead of being on the hamster wheel and always having to try to make more money to pay for ever more expensive stuff.
Interesting. That's a very interesting concept. Yeah, I know deflation, if you have debt, can be really, really challenging because obviously you have all this debt, and if we
That's why the
experience
government's
deflation,
not going to let that
that's what
happen.
they're gonna let it happen. Yeah, and then of course the depression is like, oh, we don't want deflation. But
Yeah.
now, at least at the time of this, we're at 6.5, 7%, and then the Fed just removed the transitory. You saw they removed this. Oh, it's no longer transitional. Now it's
Yeah.
actually permanent inflation, which we've known, and inflation, of course, is higher. But it's interesting to see people's response now that there's a lot of kind of okay, this is a big problem, and most people don't know what to do about it. And I think what you said earlier is when we educate people, we're really doing a service because most people, 98% of people that should be investing in multifamily syndications in your deals or in other people's deals, they just they don't even know about it. They've never done it before. And it's something that, it can feel like taking a big leap, but I think one of the best ways to educate yourself, especially as a wealthy professional, is to put, 50 to 100K in someone's deal and then just kind of see how it goes and see how you like it. And in general it'll probably go just fine, but obviously you got to do your own diligence. But that's a great way to learn because when I invest, I pay attention, right? And so that's how you learn. Any other tips for people that are starting out, or anything else people should do, or any other book recommends or resources?
Yeah, I mean, I think, like you said, invest in someone else's deal too, even if you're wanting to do your own deals. I've done that. I still invest in other people's deals, just because I know a lot of people in the industry. I like to diversify even from my own deals. So I think that's a huge way. You see how other people run things, you see their reporting, you'll learn a lot just by watching other people do what you're trying to do.
Yeah, for sure. No, that's it. That's really
Yeah.
a great way to learn. Um, well, Jonathan, this has been a really great time. I really appreciate you. I just want to honor you for the way that you have really, had a background, had so much experience with single family, and then you've continued to develop yourself and learn a new asset class and learn how to raise money and how to, doing deals, and you're adding a lot of really valuable content. So I recommend that everybody goes and follows Jonathan on Twitter and
Yeah.
also gets on his list and hears about his deals. So what's a way people, maybe how people can reach out to you, or your website or email?
Yeah, you can find me on Twitter, JB2 Investments, or go to our website, jb2investments with the s.com. I also have an ebook on there, jb2investments.com /lower. It's all about the tax incentives of real estate. And I go into like specific examples to like the cents and pennies of things that we've done.
Yeah, that's awesome. Well, hey man, I just want to appreciate you again for coming on here, and we'll have to do it again in the future. But I really appreciate all the value you're adding to everyone.
Thank you.
So Jonathan Barr has a great story, right? He started with single family, was able to do a ton of flips, and then sooner or later, people realize how much work it is. And I have a number of friends that have done transactional type of work, such as being a real estate agent, or doing flips, or doing wholesaling. And you can do it, and you can make money doing it. But the challenge with that is that it is still a time for money trade, right? You're still going in, you're still doing a lot of work, you're getting paid well for the work, but you've got to keep spinning that wheel. You've got to keep, it's almost like you're still kind of in the rat race, because you're continuing to have to do it based on a transaction. When you get into owning, whether it's single family or multifamily, it gives you a chance for equity, for appreciation, for you have debt, you're able to leverage into a deal, and especially with how inflationary things are right now, and I think will continue to be, it gives you the ability to be a long-term investor. So if you're interested in investing into multifamily, you can hear about our deals at bronsonequity.com/join. We also have a free ebook on our website you can check out. But anyway, Jonathan's story is really inspiring when it comes to just how do you continue to scale, and he's found a way to do it. I used to think syndicating big deals like it was, how in the world could I ever do something like that? But it's something that it's very knowable, it's very doable, and there's steps to be able to do it. That it's really not rocket science. Everything sounds difficult if you've never done it, but once you figure out like, oh, this is how you do this, everything becomes achievable. I believe Jim Rohn, it may not be Jim Rohn, maybe somebody else, but I think he said, if you can do it, then it's easy, right? Easy is doable, right? If it's hard, it means you can't do it, right? But easy means it can be done. And so, even if it takes work, by you educating yourself, by you learning, by you going to conferences and going to events, you are investing into yourself. You're investing in your own education. And as you live longer and longer and longer, you're going to be so glad that you educated yourself, because your money will be working for you harder because you took the time to invest in your own knowledge and your own experience and your own education. So hope this was encouraging for you. We look forward to seeing you on the next episode of Mailbox Money.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.